Australian businesses have faced many challenges over the past few years, from strong cost pressures, high interest rates to sluggish demand. But there's some good news. Our latest Westpac Quarterly Business Snapshot shows that businesses are strengthening their cash flow positions, and with tailwinds emerging, including more rate cuts, the outlook for businesses is improving. Our report draws from millions of daily transactions across our business banking clients, providing a real-time indicator of the trends and potential turning points for Australian businesses. So what does our latest report tell us? There are really three key messages. One, as mentioned, businesses' cash flow conditions are improving. Two, there is also some evidence that firms may be turning somewhat more positive about activity ahead. But lastly, while this is all good news, the recovery is still uneven across industries and states. So delving into the report, our Westpac Business Cash Flow Gauge shows that cash flow conditions held steady in the final quarter of 2024. This follows a solid increase in Q3. Overall, it stood 1.7% higher for the last 6 months of 2024 compared to the first half. Now, this indicates that conditions improved, albeit gradually. Now, both expenses and revenues did fall at a faster pace in Q4 2024, dominated by an easing in prices. This is a trend that has been evident since 2023, but as in previous quarters, the cash flow gauge can increase even if revenues decline if expenses fall by more. And indeed, business expenses have now fallen nearly every quarter since 2023 due to a mix of lower import costs as prices cool, lacklustre demand requiring less purchases of goods, and ongoing cash management. The fall in revenue also reflects cooling inflation and some likely compression of margins. In all, the takeaway is that the green shoots that we highlighted in our Q3 survey appear to have taken root, and this is consistent with our view that we have passed the economic nadir. Indeed, encouragingly, the share of SMEs that saw cash flows improving rose for the first time in 18 months. We also saw nearly 2/3 of industries record an increase in cash flows, a solid gain from less than 50% in the previous quarter. At the same time, businesses are strengthening their business sheets. Deposits increased over the quarter. And this comes even as the firms continue to invest in productivity-enhancing initiatives such as automation and digital transformation. Our data also signals that businesses may be turning more confident about the economic recovery in the coming quarters. Businesses, including SMEs, appear to be increasing total hours worked and headcount. There also has been a lift in working capital. And given the stabilisation in cash flows and a greater share of businesses reporting an improvement, we also see this as an early indicator that things are turning. However, while conditions are improving, growth is still uneven and the recovery is somewhat bumpy with some pockets of stress. Indeed, some firms, especially in the SME space, are still struggling to pass through costs fully into selling prices, and this is coming at the expense of margins. There is also still evidence of a two-speed economy, with some sectors, particularly in services, recording solid gains in cash flow conditions. In contrast, industries such as retail and manufacturing continue to face pressures from lacklustre demand. Regionally, there also remains considerable divergence. Cash flow conditions remain stronger in the mining states, particularly WA, while more consumer-facing states, New South Wales and Victoria, are lagging. Although I would like to add that the latest report showed some green shoots of convergence as household spending is gradually lifting. So looking ahead, from a broader economic perspective, we are moving into a more favourable environment. Inflation is trending towards the RBA's target, and we expect further interest rate cuts this year, which will bring the policy rate down to 3.35% by the end of the year. Now, this should ease financing conditions, particularly for businesses carrying variable rate debt, as well as support a gradual uplift in household spending and investment. Still, the recovery is likely to be relatively modest and uneven, and risks do remain. Households may continue to prioritise saving over spending. The RBA's continued hawkish bias could also slow the expected path in rate cuts ahead, while the upcoming federal election poses two-sided risks. Globally, trade tensions and political uncertainty have risen. Now, Westpac does believe that the direct effect on Australia from broader US trade tariff hikes will be limited, but Australia could still be impacted indirectly if global growth slows sharply. There are also potential currency risks from a possible broad US dollar strength. All of these will play a role in shaping the pace of recovery for the economy and businesses ahead.
The content of this recording is informational and of general nature only and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.